Hey everyone, thank you so much for tuning in to the first new video on my new YouTube channel. So I will be posting here every single Wednesday and Friday in addition to every Monday on Paul's channel. So we have our own YouTube and our own Substack accounts now because really we just want to cover as much ground as possible, and we figured that if we each have our own accounts we can make a better chance of that happening. So again, thank you everybody for tuning in. I'm really glad you are here. So in this video, first I want to go over a new index that I created kind of to gauge the action of growth stocks, because I feel that they're very underrepresented in the overall market. Then I want to go into what's going on with the Fed. I know last Friday kind of was a shock to a lot of people, both what Powell said and also what the market reacted with. I know it kind of caught some people off guard. Then I want to go into what I think the market is going to do as a result. So first, the index called this is at least a working title. I'm going to see if it catches on. If not, we can always change it. But for now, it's called the 21 Disruptors Index, and it is made up of 21 stocks. Kind of self-explanatory there, and I'm going to list them off. So a number of sectors here too. So first, manufacturing sector. We've got Desktop Metals, Proto Labs, which are 3D printing companies, Cadence Design Systems, and PTC, which are both kind of product design and simulation companies. Next, new energy resources. So we've got the metals in here. We've got Livent Corporation, which is lithium, Energy Fuels and Cameco, which are uranium, and then Mountain Pass Minerals, which is a rare earths mining company. New energy products. So we've got Tesla and Enphase, which obviously are focused on solar and storage, and Tesla, of course, with their EVs, and Plug Power, which is one of the biggest hydrogen fuel cell distributors in the world. FinTech, we've got Lemonade, which is an algorithmic P&C insurance company, and then of course Bitcoin and Ethereum, couldn't leave those out. I know they're not stocks, but whenever I say 21 stocks, it includes of course Bitcoin and Ethereum. Gig economy, so we've got Uber and Airbnb and Pinterest, all three of which I think are disrupting, whether it's transportation, freight, hotel and lodging, or the creator economy in general with Pinterest. I think these are three underrated companies really by the market right now, all very, very financially healthy as well. With healthcare, we've got Teladoc and Guardant Health. Teladoc, of course, is the one of the big leaders in telehealth, and then Guardant Health, which is a cancer diagnostics company. And then lastly, consumer staples, and this is kind of a play on words in a way. They're not typically what you would expect for consumer staples, but we've got DocuSign and the Trade Desk, which are leaders in, of course, DocuSign with bringing paperwork into the digital world, and then the Trade Desk is huge in the up-and-coming programmatic advertising industry. So two things that people use every single day, whether they know it or not. Pretty much those two companies fall into that category. So that is the index. I think that going forward every Wednesday I'm going to cover a different sector in that index and go over kind of like a medium to deep dive into the companies that underlie each sector. Probably going to go into more detail in the Substacks because I think that's going to be my more detailed method of communication anyway, but just something to look forward to. Definitely happy to get this off the ground, and I'm going to be updating on performance and everything. So we are tracking this index starting today. So that is the index. I want to talk about Jackson Hole. So of course the Fed and a bunch of different global banking systems are meeting there or met there late last week and just went over what's going on with the global economy. Jay Powell, who is the chair of the Federal Reserve, kind of surprised people because he, on the back of a huge market rally where everybody was expecting a Fed pivot, he kind of dampened that. He said that basically we need to cause more destruction in the economy through rate hikes before we can kill demand enough to lower inflation, which has kind of been the underlying tone the whole time, but the market seemed to have definitely a more dovish expectation of what he said because the market kind of tanked after he talked about that, and it's still moving down. So in order to understand the whole pivot thing, I wanted to get into what is the definition of a pivot, because I see this all over the place. It's a huge debate. Will there or will there not be a Fed pivot, referring to will the Fed continue to hike interest rates? So there are three scenarios, and again, I go over this a little bit deeper in the Substack article, but either, number one, they could immediately stop hiking rates and actually cut rates, and I think that would actually be inflationary because they'd essentially start doing QE again, which is what got us into this mess. I don't think that's going to happen. They could also, number two, stop hiking rates and not reverse, so they would just stop like ASAP hiking interest rates. I don't think they're going to do that because the job market, the unemployment is still very low. The jobs market is very healthy. There's still a ton of job openings compared to the amount of people that are unemployed. So I don't think that they're going to do that. I think they're using the jobs market as a reason to say the economy is healthy enough to continue hiking rates. So the third option here is that they continue to hike rates, they just do it at a slowing pace. I think that's by far the most likely outcome. Whether or not they do a 75-point hike in September, I think that they're going to probably dial things down a little bit after that. Meaning I'd be very surprised if we even saw a 50-point hike in November or December, which are the following two Fed meetings. But again, I go over this a little bit more in detail in the article. So basically the Fed, or the market was rallying in July and August. I think it got a little bit ahead of itself, and then Powell at Jackson Hole kind of brought people back to reality a little bit. So what does this mean for the market? If they're going to continue to raise interest rates for the foreseeable future, what's going to happen? So there's a few things to consider there. First, they could continue to raise interest rates until something kind of breaks. That's what happened in 2019. All of a sudden, the overnight lending market really broke, essentially. There was a huge liquidity problem, and interest rates for overnight lending spiked to like 9 or 10%, I believe, in one night. So I don't think that exact thing is going to happen, but I just mean something of that magnitude. Of course, if something of that magnitude happens, then they would stop the interest rate hikes and potentially even lower them. It would be best if that did not happen when we still had high inflation, because again, if they have to lower interest rates, that's going to be potentially very inflationary, and you don't want economic stimulus when inflation is 8.5% year over year. That's for sure. So right now, other than looking at the economy, the amount of cash on the sidelines, I think, is actually enough to propel the market higher potentially. And I'm not placing a huge amount of certainty or confidence or whatever on this, but I even think that we could see, under the right circumstances, if things start or keep coming in light, where month over month inflation is like flat or down for August, which is reported in mid-September, I think we could see the market rally, and by market I mean S&P, Dow, NASDAQ, potentially right around their 52-week highs, which they set at the very beginning of this year. Again, not placing a huge degree of confidence on that, but if it does happen, I think that once again the market's going to be dragged back down to reality, because there is still a huge amount of uncertainty out there. So obviously consumer spending has taken a hit. Personal savings are way down, I believe, to their lowest point since at least 2013. So inflation is really doing a number on people's savings accounts. Meanwhile, credit card debt is at new highs. So this is going to be partially offset with the fact that people are going to be asking for higher wages to keep up with inflation, and that's why you see such a strong jobs market, and that's going to boost that as well, because people are going to go essentially wherever they're paid the most. And you could argue that that's even going to keep inflation up longer than expected. So if we do see a rally in the broader indices over the next couple months, I think that it's going to probably be short-lived. I even think that the rally in August was, people got a little bit of FOMO, but there still is so much cash on the sidelines, the highest since I think all the way back to 2001, I want to say. But there's a chart, of course, of this in the Substack. But regardless, the most cash that there's been in a very, very long time is just sitting there. And if people even get the slightest bit of FOMO, I think it could lead to a chain reaction here. And I know this sounds, bearish, negative, whatever, But as I've said before, it would not surprise me if the S&P actually made new lows, goes lower than it did in June, just because the likelihood that that rallies are kind of naive at this point is, to me, very high. And a lot of the companies that make up a big portion of the indices are in super decline mode when it comes to actual growth. They do things like, pay dividends, buy back shares with all of their spare cash, and as a result, they're pretty reliant on debt, and it's just really, really suboptimal use of cash, and as a result, their balance sheets are weakening, their growth in sales and profits is weakening, and that's not going to get any better under this type of economy. So I think that the S&P has a decent chance, and I would say that this is probably my most likely outcome, is that it actually goes back down to the high pre-COVID, which I think was just under 3,400. Now, if that happens, that's why I wanted to get the 21 Disruptors Index out there, because those stocks, I think, combine to form a really, really solid portfolio of all kinds of different companies that are going to weather the storm really no matter what. And I'm not saying that there's not going to be any downside there. Sure, if the S&P goes back down to 3,400, you might get hit if you're in there, but the likelihood that all of the stocks crash in that index is very low, and that's because you've got everything from uranium mining to 3D printing to product design companies to like DocuSign to Bitcoin. The chances of that many companies that benefit under different economic situations all crashing, I think, is very low. So I wanted to get this index out there as a way for people to kind of get something new in their portfolio. Maybe they're not sure what to buy, and I can tell you, whenever I talk to people about the market, their first question is, what should I buy? So that's essentially I wanted to do with these stocks, is answer that question for anybody who's wondering that. And of course, it's totally up to you and your financial position. It's not financial advice, but I do think that these companies represent a really strong area of the market. A lot of them are down quite a bit, and I think that they are at very, very, very good prices right now, just considering the future prospects of demand for their products and their services, their sales growth. The amount of cash that some of these companies have is just crazy when you compare it to their market caps. So I think that, if you look through these stocks, you're going to be happy. I'm going to, again, go over them in future updates. But that is really what I wanted to get out there today. So thank you, everybody, so much for watching. And again, I will have a video up on this channel on Friday to talk about crypto. So make sure you tune in then. And until then, have a great couple of days, and I will see you next time.